Three digits. That's all it takes to decide your future. You apply for an apartment, denied. You want a car loan. The interest rate is double what your coworker got. You try to get a credit card with decent rewards, rejected. And nobody ever sat you down and explained why. Your credit score is running your financial life, and most people have no idea how it actually works. They just know it matters. By the end of this video, you'll understand exactly what builds it, what destroys it, and how to fix it. Starting this week, a credit score is a number between 300 and 850. It tells lenders how risky you are to lend money to. That's it. It's not a measure of how responsible you are. It's not a reflection of your character. It's a prediction. Specifically, it predicts how likely you are to pay back borrowed money in the next 2 years. The higher the number, the less risky you look. The lower the number, the more they charge you, or they say no altogether. Now here's the part that trips people up. Your credit score is not one single thing. It's made of 5 separate pieces, and each piece carries a different weight. Payment history is 35%. Credit utilization is 30%. Length of credit history is 15%. Credit mix is 10%. And new credit inquiries make up 10%. Most people focus on the wrong pieces. They obsess over hard inquiries when the two biggest factors, payment history and utilization, control 65% of their entire score. That's where your attention needs to go. Payment history. 35% of your score. This one is straightforward. Every time a bill is due, did you pay it on time? Yes or no? That's all the system cares about. It doesn't matter if you paid $25 on a $3,000 balance. As long as you made the minimum payment by the due date, it counts as on time. But miss that due date by even a single day past the grace period, and it gets reported as late. That late mark stays on your credit report for 7 years. 7 years for one missed payment. According to FICO, a single 30-day late payment can drop a good credit score by 80 to 100 points. If you had a 740, you could wake up at 640. That moves you from a prime borrower to subprime overnight. Now let's talk utilization. This is the one almost nobody understands. Credit utilization is how much of your available credit you're currently using. If your credit card limit is $1,000 and your balance is $900, your utilization is 90%. The system sees that and panics. It thinks you're desperate for cash. Even if you plan to pay it off next week, the system doesn't know that. It only sees the snapshot. Most experts say to keep your utilization under 30%, but the people with the highest scores keep it under 10%. So on a $1,000 limit, that means carrying no more than a $100 balance when your statement closes. The key phrase there is when your statement closes. You could spend $800 in a month, but if you pay it down before the statement closing date, your reported balance might only be $50. And that's what the credit bureaus actually see. Now let's put real dollars on this, because a credit score isn't just a number on a screen. It's a price tag on everything you borrow. You want to buy a car. The average new car loan in America right now is about $40,000 over 6 years. That's 72 months. If your credit score is 780, you might qualify for a 5.5% interest rate. Your monthly payment would be about $660. Over the life of that loan, you'd pay roughly $7,500 in interest. Now let's say your credit score is 620. Same car, same dealership, same loan amount, but your rate jumps to 12.5%. Now your monthly payment is around $780. That's $120 more every single month. And over 72 months, you'd pay about $16,200 in interest. The difference between those two scores is $8,700. Same car, same person, different number on a screen, and it gets worse when you zoom out. According to a study by LendingTree, Americans with subprime credit scores pay an average of $42,000 more in interest over their lifetime compared to people with excellent credit. That's $42,000, not for a better house, not for a better car, just for having a lower number. That $42,000 could have been a down payment on a home. It could have been 10 years of investing $350 a month. Instead, it goes to banks and lenders as profit. Here's the sentence you need to remember. Your credit score doesn't determine how much money you make. It determines how much of your money you get to keep. Every point below 740 costs you real dollars. Every month you carry high utilization or miss a payment, you're writing a check to a lender you'll never even meet. And the cruelest part, nobody explains this when it actually matters. Not in high school, not at your first job, not when you sign your first lease. So who benefits from you not understanding this? Lenders, credit card companies, auto dealerships, insurance companies. The entire system is built to profit from your confusion. Think about it. When you walk into a car dealership with a 620 score, the finance manager doesn't educate you. They congratulate you on getting approved. They tell you the monthly payment, not the total cost. They make more money the worse your credit is. Because higher interest means more profit for the lender, and the dealership gets a kickback for placing you in a higher rate loan. It's called a dealer reserve, and it's completely legal. Credit card companies are even more clever. They send pre-approved offers to people who carry balances, not because they want to help, because someone who carries a balance pays interest. That's their business model. According to the Consumer Financial Protection Bureau, credit card companies earned over $105,000,000,000 in interest and fees in 2022. That's billion with a B. They need you to carry a balance. They need you to make the minimum payment. They need you to not understand utilization. Even insurance companies in most states use a version of your credit score to set your premiums. Lower credit, higher insurance rates. You're not paying more because you're a worse driver. You're paying more because the model says you're more likely to file a claim. The system doesn't want you educated. An educated consumer is a less profitable consumer. Now, the most common objection people have is this: I already have a low score. So what's the point? Here's the point. Credit scores are not permanent. They're rebuilt every month based on current behavior. FICO updates your score every 30 to 45 days. That means you can start changing your number right now, not next year, now. Step 1. Set up auto pay for every single bill. Not the full balance if you can't afford it, just the minimum payment. The goal is 0 missed payments going forward. That protects the 35% of your score that come from payment history. Cost to do this: $0. Step 2. Call your credit card company and ask for a credit limit increase. If your limit goes from $1,000 to $2,000 and your spending stays the same, your utilization drops in half overnight. Most companies will do this if your account has been open for 6 months. Cost $0. Step 3. Pay your credit card balance down before your statement closing date, not the due date, the statement closing date. That's usually about 21 days before the due date. Check your account online to find it. When you pay before that date, a lower balance gets reported. Your utilization drops. Your score goes up. Step 4. Check your credit report for free at the government-authorized site once a year. According to the Federal Trade Commission, 1 in 5 Americans has an error on their credit report. That's 20%. Disputing an error takes about 15 minutes and can raise your score by 25 to 40 points. These 4 steps cost $0. They take less than an hour to set up, and within 60 to 90 days, you can see real movement in your score. 2 people, both making $50,000 a year. Same city, same rent, same bills. Person A doesn't think about their credit score. They miss a payment here and there. Their credit card is usually maxed out. They never check their credit report. After 5 years, their score sits at 610. When they go to buy a car, they get a 13% interest rate. On a $30,000 loan over 6 years, they pay roughly $13,400 in interest. Their car insurance costs about $180 a month because of their credit-based insurance score. When they try to rent a nicer apartment, the landlord asks for 2 months deposit instead of 1. Person B takes 1 hour to set up auto pay, and request a credit limit increase. They pay their balance before the statement closes each month. They check their report once a year and dispute one error. After 5 years, their score is 780. Same car, same dealership. They get a 5% rate. On that same $30,000 loan, they pay about $4,300 in interest. That's $9,100 less than person A. Their insurance is $110 a month, $70 less. Over 5 years, that's $4,200 saved on insurance alone. The apartment gives them the standard 1-month deposit. Add it all up. Person B saved over $13,000 compared to person A in just 5 years. Same paycheck, same city, same starting point. The only difference was understanding the rules of a game that nobody taught either of them. Person B just learned first. This is not your fault. Nobody taught you this. Not your parents, not your school, not your first employer. The system made money from your confusion, but that ends today. You're not someone who ignores their credit score anymore. You're someone who understands the rules. And when you understand the rules, you stop paying the penalty for not knowing them. Nobody taught us this about money. So let's talk about it. Subscribe so nobody catches you off guard with money again.